All right, so welcome to the Short Vol Show live. My name is David, and I just thought we could do some kind of trade ideas today. I'm still having not problems, but well, the truth is, I left the stupid cord somewhere, so my second monitor is kind of inoperational right now. But that doesn't matter because I can still work it with one monitor. It's very easy. Like, you can't expect somebody who can't figure out two monitors to actually be able to teach someone to trade options, right? So I just want to do some trade setups today. If you are new to options trading, then hopefully you still get something out of this. But essentially, the plan is to give some trade ideas to. This is like for somebody who has a brokerage account that is set up to do options, and there are some sort of short-term ideas to make you money, to make whatever money is in your account into more money, and they're based on some basic concepts. One of them just being that the probability of a stock moving out of a certain range. So, you have a stock, let's say Tesla, it's in a certain range, and I'm going to disappear off the screen here, and we're just going to see the display with the charts for a while now. So here we go with that. Okay, so if you pull up something like Tesla, it's kind of in a range, or it's going to trade in the next couple weeks. It's not going to trade every price in the world, right? It's going to trade in some sort of range, which we don't know ahead of time. But there are options for prices that are going to be well outside of that range. So, for example, if we look up to June here in Tesla, the at-the-money strike is the 235 strike. And, Tesla is down very low in its band over the last, it has been trading in this sort of band, which it looks like it almost might be breaking out to the downside here, which I don't really believe. I kind of believe that, well, even if the band is slowly moving lower, we're going to get another pop rally here. But regardless of whether we get a rally or a sell-off, it's only going to trade within a certain range here, and thus, the idea would be to sell options that are at prices that are unlikely to occur, and in this way, collect money. So, with the Tesla at 235, we could look above 235. So we could go up to like 300. And the thing is with options and probabilities and things like that, the higher the probability is of a trade working for you, the less money you're going to get for the dollars invested. So, for example, if you want to say, oh, well, I don't think that Tesla is actually going to go through the 240 strike, even though it's trading like, 235, and it traded up to 238 after the close. If you say, well, I don't think it's going to go through the 240 strike, selling something like the 240, 240, 245 call spread is going to collect you a lot of money if you're right. However, it's perfectly likely, if not probable, that you're going to go through that strike at some point. And so selling the 240, 245 call spread is almost just like a 50-50 shot. It's almost like, putting money on red on the roulette wheel and seeing what happens. However, if you were to go up higher out away from where the stock's trading now to say, up to like 275, let's say. So if you sell the 270 call and you buy the 280 call, okay, so you could sell this 270 call and buy the 280 call and collect, let's say, $2. And let me just back up and say, I apologize for those who are not as option savvy as others. Some people are going to think that this is too basic. Other people are going to think this is too complicated. So I'm trying to find some sort of sweet spot. But anyways, I'm discussing right now selling a $5 call vertical. So what that means is that we would be selling the 270 call and we would be buying the 280 call. Sorry, so that's a $10 vertical. So there's $10 between the 270 and the 280 strike. If you were to put this trade on, what would happen is if Tesla ended up below 270 on expiration, then you would collect whatever money you sold this for, in this case $2. If Tesla ended up above 280 at expiration, then you would lose whatever the distance is between the strikes, that $10 minus whatever you sold it for. So $10 minus 8, so you would lose $8 if Tesla closes above 280. If Tesla closed between 270 and 280, then it would depend. The break-even point is 270 plus the $2 you sold it for. So up to 272, you're making money, and from 272 to 280, you're losing a certain amount of money. We can kind of tell a little bit the likelihood of this happening here by looking at the delta of the option. So if I were to switch my screen here to deltas, it's going to give the 270 call a 28 delta. So that's basically telling you that there's a 1 in 3 chance of this reaching 270. Being above 270, being at or above 270 at expiration. It's about a little bit less than 1 in 3 chance. So, you are taking some risk by selling the spread. However, and if you look at it, you can look at this risk in terms of probability. Thus, there's a 28% probability of this going against you, or you could look at it in terms of dollars risk for dollars gain. So you're betting. Basically $8 to make 2. So you gotta you can look at that as a ratio. So if I were to load this trade into my into a ticket here and hit confirm send, it will express that sort of that way as well. So maximum loss can be $800, maximum profit's $200. So you're putting up $800 to make $200. Is another way of sort of expressing what risk you have here. So this is like a way of, if you were to look at Tesla and you were to look at, standard deviations of how far away from the price now this is likely to move. Basically the options are going to price stuff efficiently for what the market thinks that this is going to move. So the market thinks there's a 30% chance that this could be above 270 on expiration for these options. Now, this is June 21, so the options we were looking at. So June 21 is 55 days from now. And so this is an example of like selling some upside that in Tesla to make some money. Now, and this is like one level of risk, okay? Selling the 270.80. There's other levels of risk too. You could pick something that's like way less likely to occur, and you're going to collect less dollars, but it's going to be almost a sure thing. So let's say, you have an account that has $10 million in it, right? And you just want to collect a little income. You could go all the way up here to like say the 400 strike, okay? It's pretty unlikely that Tesla is going to get to 400 anytime soon, right? And you could sell the 400 strike, like maybe you could put an offer in and sell the 400 calls for 20 cents, okay? And not do a spread, just sell these for 20 cents. Very unlikely it's going to happen. And my account is not. Something's wrong with it right now, where I can't look at the at how much it's going to cost for this. And I know what it is that this particular account is it doesn't have the buying power to look at it. But anyway, you could sell like way out of the money options, right? Like you could sell these 400 calls for 20 cents each, or 15 cents each, and and it's almost a sure thing, and you collect just a little bit. But if you sold a bunch of these calls, it turns into a decent amount of money. And this is the kind of thing that if you do this, you do have this risk on that, like if something amazing happens to Tesla, that if you sell a bunch of these units way out of the money, you do have significant risk. And that's why I don't generally do a lot of trades like this. If we wanted to look to the downside, you're going to see meteor trades like this, because generally puts are skewed to be higher. There's more of a likelihood that if Tesla or any stock in general makes a huge move, it's going to be to the downside, unless it's like a company that's like a biotech that is trying to cure cancer or something. Most stocks, the chance of a violent move would be to the downside. So if we look to the downside in Tesla, you could go down to something like the 160 put. Okay, instead of 20 cents, you're looking at $3, which is a lot fatter premium. Now, it's pretty unlikely that Tesla's going to go to 160 anytime soon, and thus selling some of these puts can be a great way for you to collect some money. And you don't even have to sell them naked. The good thing with selling naked puts is that you know that you're backstopped at zero. They can't go below zero. So it's not like you can lose an infinite amount of money like selling naked calls. But realistically speaking, if you want, you could sell a put spread instead. You could sell the 165 put, and you could buy like the 100 put against it maybe. And thus collect some money. And this is, once again, this is kind of a high probability trade. The 160 put is an 8 delta, okay? So less than 1 in 10 chance that this is going to, according to these models, that Tesla could see 160 on expiration. And you're collecting a lot of money, $300, over $300 per contract to sell these naked, or let's say $200 if to sell the spread. Well, let's see what it says for the midpoint of the spread here for the 160 190 put spread, 239. So this is a way that you can make money quick. I mean, there's 55 days till expiration. We could even move forward to next week. Okay, 6 days till expiration, and you could go down and sell something like, Tesla's 238. You could sell something like the 200 190 put spread. Okay, so Tesla hasn't seen $200 in I don't think it's been several years. You could sell this put spread, and I don't think that's a great deal. So let's say like the 200 170 put spread or something. Or just sell the puts naked and monitor them. 200 170 put spread. Collect 62 cents. Sell a few of those, and you're collecting real money, and you get it. The trade's over in 6 days, and there's more money in your account. And I wouldn't suggest that you go big, especially just starting out with these. If you don't know the stocks that well, that you go big, but maybe you do 10 of these spreads in Tesla, and then you move on to another stock. And I like to pick the sort of higher vol ones, but lower vol ones can be even better in a way, in that lower vol ones can be more predictable. That's kind of why they're lower vol. And so you can pick a stock that's lower vol, something like a bank. A lot of people have been looking at Boeing lately. That's been like a big one to trade because there's some volatility in there. It's a higher price stock, $380. It's been bouncing around in a range. Bad news came out last week and it went up. There's some of these options look kind of rich just because it's a high price stock. You want to be a little bit careful. The volatility is low, but the option premiums are real. And if you pick something like June, you can do something similar to this sort of Tesla thing, and you could sell like the June 340, 310 put spread to collect some income. And these trades have risk in them. The stock can move, but these are ways that you can make some money in the short term, and it's and you are taking some risk, but it's not like you're taking a risk like the majority of people in the US do when they buy like lottery tickets and scratch tickets where the odds are against you. In these trades, you are, quote unquote gambling in a way, but the odds are in your favor. So, and we could have a esoteric discussions to say that the odds are not in your favor; they're just fair because the option market prices stuff fair, and we could have a debate on whether the option market does price stuff fair. But either way, you're not putting yourself in a situation where the odds are stacked heavily against you, like most people do when they gamble their money. This is a situation where the odds are much better for you than any of those situations, whether it be sports betting or scratch tickets and lottery and all that garbage. And these are risks that are very quantifiable that you can select yourself and you can fine tune yourself. There's some people out there who, and I did some trades where I was doing completely at the money trades. Like, let me give you an example. Xilinx. I hadn't played Xilinx since I was a market maker in there, which was I left trading Xilinx as a market maker in like 2002. I went back in there for earnings, and the chart was things were going straight up, so I figured I would do a really small at the money option sale on earnings, and I sold an at the money spread. So, for example, let's say Tesla earnings or Xilinx earnings was tomorrow. I sold something like the 118, 120 call spread here. So sell the 118, buy the 120 call spread. And this is a $2 spread, and I was selling it for a dollar. So basically 50-50 chance of getting it right. However, with the chart going straight up like this, again, you can't predict what a stock's going to do, but I was bearish on it, and so I decided to sell the call spread as opposed to buying it. You could sell it for $1 or buy it for $1. Either way, it's sort of a 50-50 shot. I sold it for $1, and it went lower. And this is just an example of using options when you have an opinion of something to express that opinion and to put your money where your mouth is as far as an opinion goes, would be to sell an at-the-money call spread. So once again, call spreads and put spreads are the same thing. So you could either sell the 1820 call spread for $1, or you could buy the 1820 put spread paying $1. It's the same thing. In this case, the call spread is slightly in the money, the put spread is slightly out of the money, and therefore it shows the call spread 97, the put spread 104. But it essentially the same trade, whether you're paying 90 cents, whether you're selling for 90 cents or buying it for 104, you're still going to roughly double your money if you're right in this particular trade. If you wanted to be, if you thought, well, I'm pretty sure it's going lower, but I'm not that sure, then you could go and sell an out of the money call spread. You could sell like the 125, 130, something like that. Now, when this trade went on, we were up around the 140 level. So I was trading the 140, 138 call spread is what I was selling. So the 140, 138 call spread at $1. You could also conceivably sell a $5 spread if that was your interest. So what I would suggest to you, when you're looking for trades coming out this week, for example, would be to go and figure out what stocks are having earnings next. StockTwits has an earnings calendar. There's many resources out there online that have earnings calendars that will tell you, okay, what earnings are coming out next, and I would focus on those stocks. We've got this is last week, but let's go to next week. So we've got Google Monday, Google earnings, Spotify, Apple Tuesday, AMD Tuesday, GE, Squarespace Wednesday, Fitbit Wednesday, NBEV Thursday, Win Friday, and plus many others. This is giving a list of all the stocks, and go through these. I mean, obviously GE's been one that's interesting to trade lately. Let's look at Apple for a second. Apple's made this huge comeback since December. Does it continue or does it fade? Sort of medium volatility issue there, 40 something vol, but 40 vol in a $200 issue does give you some play. GE obviously has had this sort of comeback as well, but has been unable to hold that $10 strike. But has been some interesting play. The issues like GE or Apple, they're liquid, so that means that there's going to be a robust options market where you can trade stuff basically at fair value. If we look at GE, for example, volume, open interest, when we're looking, look at this, weeklies, okay? Usually weekly strikes are like not a lot of volume, but look at 28 days out weeklies, we're seeing some volume here. 13 days out weeklies at the money strike, 3,400 contracts, 1,100 contracts. If you have at least 1,000 contracts trading per strike, then you've got action going on, and it's going to be a good spot for you to go in and play. You don't want something that's totally illiquid, because then even if you're right, they're going to like hold you hostage to get out of the trade. I was doing this FGen stuff the other day, and totally illiquid, and they're holding me hostage to get out of the trade. For example, I was trading in and out of the SEP June 50 put vertical, SEP June 50 put calendar, and the fair value was like 145, but if I wanted to sell it, I had to sell it like at 115 or 120, and if I wanted to buy it, I had to pay like 175. That takes out most of your edge for trading. If you're right by 15 cents, well, it's costing you 15 cents to get in or out. That's not something where you're going to be able to be profitable. So, a Tesla or a Netflix, where there's action and there's liquidity, is where you want to hang out. I would check out CGC. For some reason, I haven't been playing this one all that much lately, CGC. I was playing it when vol was a little bit higher. But, the higher this stock gets, I like stocks with a little bit higher price, but 50 isn't bad. Another spot that I look to find ideas is barchart.com, and, I talk about this a lot. Go to barchart.com and go to highest implied volatility. Look for stocks with higher prices. It's highlighting Tesla here. TNDM. And then percent change in most active options is good. That's going to tell you, something that is hot. Disney here, Ford, Intel. You're familiar with some of these names. Percent change in volatility. That's also going to show you tell you what they're coming for. Like Ford. 7 call, open interest, implied volatility change. It's still really low. Anyway, but you can go through these scanners and look at stuff. And there's a lot of people that are going to play each earnings, whatever the earnings of that day is, and not necessarily that you want to play all these, but be aware of what people are doing right now, what people are focused on, because the stocks that are going to move are going to be the ones that everybody's focused on for that earnings, and usually earnings is a inflection point for stocks. So let's go back to our screen here. So the example there was to pick some out of the money options in some stock and sell some out of the money, either call spread or put spreads, to make some money next week. If you have an opinion on earnings one way or the other, it can be directional. Otherwise, just pick something that's unlikely to happen and sell some, sell some stuff on the edges of what's likely to happen to collect some money. All right, and so that's it for today. And thanks for watching. And thank you for all your support. We'll see you next time on the Short File Show Live. My name is Dave.